Tim Quast, CEO of Market Structure Edge. Tim, good morning. Happy Monday. How was your weekend?
Good morning. Happy Monday to you guys. It was good. I was recovering from vacation.
Don't scare us.
We all are doing that, Tim. You know what?
Right.
It's crazy. Joel took a vacation. I took a vacation, and the whole family came back sick, which is scary. We went camping, and my wife had the flu for 3 days. She got a COVID test. She was negative. Both kids are still fighting some barky coughs, and Natalie had a fever as high as 104, which was scary for a day. Like, I was scared we might have actually picked up the Delta variant, right, but apparently we didn't with the negative test. I kind of fought it off. But it's like you go on vacation here, and now you got to recover because you know what? Our immune systems are so low. Somebody coughs or looks at you wrong, and you get sick.
That's right. It's the consequence of our bubble world existence.
Yeah, true.
So are you healthy? That's the first question. Did you guys stay healthy?
We did. So we employed the vital health strategy of consuming wine. That's
good.
Alcohol
kills everything.
I have to recommend. So if your listeners and viewers have not been to Lake Canandaigua in upstate New York, the Finger Lakes, so there's Canandaigua and then Seneca right next to each other. I recommend it. And there's the whole wine trail along Seneca Lake is just spectacular. And so Henry J. Weimer, Wiemer, Henry J. Weimer, great winery, one of the pioneers of the Riesling boom there in upstate New York. They make beautiful Rieslings, beautiful Cab Francs. So that will keep you healthy. If you go out in the woods, you're going to get sick, Dennis. You need to.
Maybe I asked for it. It did rain pretty hard on us that last day.
Did it? Well, it's been a wet summer. It was that way in upstate New York too. Because it wasn't rainy, but it's usually 95% humidity, and it was very pleasant. And the locals said it's been much wetter. And so that's not that far from where you are, I don't think, Dennis. It'd just be up to Niagara Falls and over the border, wouldn't it?
Yeah. So
little ways.
Little ways.
All right. Yeah. Tim, the theme for the past couple of weeks as it relates to earnings season has been numbers blown away, amazing, reactions not so great, right? Why is that, you think?
Well, so it from a trading standpoint, one is naturally reminded of Sun Tzu and the art of war, of course.
Obviously.
Of course. I mean, that's tactics without strategy is the noise before defeat. So if you expect that just great numbers are going to result in great outcomes, and you haven't studied the demand and supply equation in the stock market, you're going to be surprised. And to me, it's that simple. Of course, I'm a devotee of market structure, and I think that it reflects the most basic economic principles of supply and demand. I put demand first because in the equity market, demand drives the market, supply influences its strength. And those two things, when you look at them heading into earnings, we talked about this, last Monday, that I didn't expect that the market would do poorly because sentiment was bottoming, but I didn't expect that stocks like Tesla would necessarily do. And I heard you were talking about Tesla, and I'll show you what changed. Yeah. I said that to looking at Tesla, I wouldn't buy it now. I want to buy rising demand and falling supply.
Let's look at Tesla because a lot of people are talking about it this morning.
Okay, well let's have a look at this from a market structure standpoint. So if you're following along, you can do this, everybody. If you haven't yet tried Edge, just go over here and you can put your name and email in, and it doesn't take a credit card. You can do this for 14 days and come back next Monday to pre-market prep, and we'll talk about what's changed. So let's look at Tesla. And I have not changed any of these. In fact, I didn't change the date, with apologies. I meant to do that. But I wanted to keep the same stocks because let's look at Tesla here. Now,
can you share your screen?
Oh, did I not finish that? Oh, no. Sorry. This is what happens when you go on vacation. You forget how to do stuff.
It takes you a couple days to get back in the groove.
So it's not July 26th, it's August 2nd. But okay, so here is how you will see Tesla in an edge portfolio. It's a set of numbers that tell you the supply-demand equation is dead even at 5. Sentiment is trending up, though. That's what you want. You want to buy rising demand. Supply side, 38%. Just compare that to Amazon at 47% short. What that's telling us is the percentage of volume coming from borrowed stock. So high-speed traders, we call them fast traders. So Apple, by the way, is led by that behavior. Here it's indexes and ETFs. Believe it or not, the new money is going to come in, and money wants to be allocated to Tesla. And it doesn't matter what the stock pickers think. If passive money is being allocated to Tesla, it will rise. And so you want to know those things when they're occurring. These things look, this is a change. If we look at the data visuals here, here's what happened. When we talked about this last Monday, I said, well, it's demand is below 5. So stocks tend to do better. The gains tend to come when it's above 5, excess demand. And I look at the supply side of the equation, not great, it's not terrible, but look what happened. You don't have to capture all the gains, but you want to buy rising demand and falling supply. So supply trended below the trend line and demand rose. Well, now I'm going to buy that. That's what you buy. And that will capture gains and avoid losses. That is the strategy. The Sun Tzu strategy of edge is capture gains and avoid losses. The tactics are buy demand, rising demand, and supply that's constrained, and avoid the opposite of those conditions. So that's why Tesla is rising. And could it continue? Well, go back here. We can have what happened the last time? Well, when it got up to 10, and then demand began to wane and supply jumped above trend, price fell. Now, it's not perfect. It will be lumpy. Price is capricious. Whereas supply and demand are not. They're predictive and fairly consistent. And so you could just wait until, now we've got this rising demand and falling supply equation. That's what we want to buy. And now you can capture those gains. And it's not about the numbers, people. It's not about the numbers, because if it was, you would see active money as the lead behavior. It is purely models that say, well, there's an awful lot of exchange-traded funds that want some exposure to the things that Tesla represents, whether it's ESG or EV or pick it. Consumer discretionary is a huge part of the consumer discretionary allocation now, and that is how the market works. And indulge me for one more moment, because I think there's a very important overall lesson about the market. The market is about time frames, purposes, and horizons. High-speed traders, fast traders, are continuously sifting supply and demand, and they have the shortest horizon and the least risk. Passive money has a little longer horizon, but they're following a model, and wherever they vary from their model, their strategy, they hew back to it, and that happens generally monthly, maybe even 2 times a month. So a little more risk, but still a constrained risk. You know who's got the greatest risk of all? Buy and hold investors and corporations, because their horizons are years out, right, and which then take into account all the things that can go wrong over those years. And so time is risk. And that's why I say you want to you have to eliminate time as your risk component. And that's what we try to focus on with Edge. There, that's the art of war thought for the day.
I can never quite know which direction these are going to take it, but I do know there's always going to be some obscure reference to some random thing when Tim joins us every Monday. So, Tim, what are you looking for this week?
Well, there are 1,600 companies reporting. So isn't that something? This is actually the heart of earnings. Yes. You would have thought last week was, but this is it. And the companies who are reporting this week are at a distinct advantage over the people who reported last week. Why? And once again, it's a concept of how the market works. Last week was month-end window dressing. You're going to true up your model. If you're a hedge fund, you want to lock in your gains so that when you send a statement to your customers, your clients who have funds with you, that you can report that you had a good month. Well, that's difficult if you're reporting into that. It's much better to report in a new month, particularly the first week or so, because that's when new money comes in. So I could write our market desk note and look at the trends in the market. I wrote it yesterday for I send daily notes to Edge subscribers. And I could look at the broad market sentiment trend, and it's rising. I could look at all the trend lines across my dashboard. They're rising. And I already know what the market's going to do today. I don't have to wonder because all the demand charts are up and to the right, and it's the new month and money's going to get deployed. Now, the question is, how much staying power does that have? But that means, to answer your question, Spencer, that it's probably a better, this would be a better week than last week to have exposure to companies reporting results. I tend to avoid that. I sold Facebook on Tuesday, even though the data was fine, because I don't like those conditions. I don't like the capriciousness of what happens to stocks with earnings, because there's so much speculation and the use of derivatives, and then it's month-end window dressing to boot. I don't want to get caught in that. And so now we're out of that. So it will be a better week, at least for a few days, and then we'll see. I'm still concerned, and we can come to that at the end if we want, about the big picture. But that's what I think will be the case this week. I think it'll be a pretty good week.
We got so many companies reporting. I just want to go to a couple specific ones because everybody's been talking about Alibaba. It's been trading like a yo-yo up and down. I'm going to report tomorrow morning. Would love to see the market structure sentiment on Alibaba.
Let me fix this while I'm at it. Okay.
This would be interesting.
And let anybody else I should add while I'm at it, Dennis?
Yeah, sure. If you're in here, I was going to look. Roku is going to report on Wednesday. General Motors as well on Wednesday. So those are big reports that I'm watching.
Okay, GM.
Can you add RCL to that?
Yeah, absolutely.
It's also Wednesday. Okay, cool.
Okay, RCL, and let's see, General Motors. There we are. Okay, let's take a quick look. We'll do this really fast. So Alibaba, it's miserable. You look at that, 1.8 and down.
Yeah.
Once again, what's the lesson, traders? You want to buy rising sentiment. They don't want to buy falling sentiment. I don't
You're
care
not
what
seeing that happen yet.
Right. I look at that and say, it's not great. The supply side's fine. It's, there's no supply side issue, but the supply side also tells us there's no excess demand. High-speed traders can manufacture stock. We talked about the exemption from the short locate rule. I look at this and say, boy, things have to change before this offers opportunity. You're taking a big risk with Alibaba right now, just from a supply-demand perspective. So then let's go look at Roku and RCL, and then GM. So here's Roku, 10 out of 10 top, 61% short, passive money leading. I mean, that's remarkable. The trouble is most of the gains probably have been realized. So, it's peaked. So look at this. Demand has hit the top and supply is rising. It doesn't mean that it's going to collapse it, but no matter what, I never buy a 10 out of 10, 61% short stock into earnings, because I have seen for more than a decade providing analytics to public companies and telling them this very same thing. You're going to report great results and your stock's going to go down 8% because demand has peaked and supply is rising. And that's what's happened. It's market structure. It's not your story. You got to make sure your executive team knows that. Otherwise, the IR team is going to get blamed for blowing the message. And it's not the message. It's supply demand. So Roku, my view, avoid it. So let's look at RCL. 9 up, 55% short, fast traders leading. Again, that's a difficult chart. I wouldn't buy it. It doesn't mean it's not going to do well. If we looked at that whole group, I'm going to go to the dashboard because I track this group all the time. And you can see it. The first portfolio will be airlines and cruise ships. And, here was the ramp, the steep ramp and the drop in short volume. There was a brief opportunity in this group, and I think it's about done, unfortunately, Joel. I think it's challenging to me. That to me would be you're taking a bigger risk with that group. So last one, GM, right?
Yeah.
Okay, let's take a look at that. Best of the group to me. It's a 5, trend is up 32%. So rising demand, limited supply. High-speed traders think there's going to be an increase in demand for it. That's why they're out front. So even though that ticked up a little bit, it's right at trend, and there was a nice covering that occurred right ahead of this move up in demand, I look at that and say, that's a pretty good bet. That's one, if out of any of them, that's what you would buy heading into earnings, I would say.
All right, Tim Quast is the CEO of Market Structure Edge. The link is up on the screen. It's also in the description. Tim joins us every Monday, and we appreciate it. Guys, smash the like for Tim. Great stuff as always, Tim.
I just did.
See you next week.
I like Tim.
Good to see you guys. Thanks a bunch, guys.